Raleigh, all right. Thanks, man. Hey, welcome everybody. It's this week's roundtable here. Don Yocham, and we have got some great guests for you. We've got Garrett and Jack. Can't wait to talk to them a little bit about what's going on in the markets. We're going to talk about the Fed decision coming up in about 3 weeks. We are going to talk about the bank earnings coming up, regional bank earnings. So that's a big deal, right? We've got they're the ones getting squeezed by the Fed the most, and so we really want to find out what they have to say about that. We're going to talk a little bit more also about the commercial real estate and a couple other topics. So can't wait to dive into that. You know, the markets are starting to weaken up a little bit based on the way Fed futures are trading. It looks like they didn't quite like the CPI. Maybe it was the core CPI that came in a little bit higher than expectations, or at least higher than previous. So Fed funds futures are just priced in a little bit more confidence that the Fed is going to hike another 25 basis points. Anyway, with that, guys, Garrett, Jack, love to have you guys. There we go. Hey, Garrett, how you doing?
I'm good. How are you today? I'm traveling.
Oh, yeah. Okay. Yeah. All right. Where are you going?
I'm in Baltimore, and then I'm heading to New York for an event tomorrow night at the New York Stock Exchange.
If you're in Baltimore, man, if you got time for a drink, you let me know.
I will. I'm flying out at 5:30, unfortunately.
Oh, okay. All right. Well, another time. And Jack, we got you here.
Yeah. Thanks for having me on. I'm still down.
Yeah. No, it's great to have you, man. Love having you guys on. All right. Well, why don't we kick this thing off a little bit? So, and Garrett, I'd love to start off with you. What are your thoughts around the next Fed decision? So, and let me share something on my screen real quick here. Let me find, give me 2 seconds. I'm reasonably prepared here. Okay. So this, just so, and you can actually, and I'll bring it up. But what do you think? What do you think about the Fed's next move? And what it means, and really, what is it? So if you look at Fed futures, they're pricing in a 25 basis point hike at this next meeting, then a pause, and then a cut, right? So a quick turnaround, and then we're off, and I think probably down like 50 basis points or something. I'll pull it up here in a second. But what do you think that trajectory is going to be, and what are they discounting, man? What are they handicapping when they're making their decisions?
A couple of things that are critical. One, you're right. We're going to go 25 points in May. I think that's a lock. But the key thing to focus on, that CMI report was calculating March CPI. That's when oil was at $65. That's a really important thing to think about. Oil's up about 20 to 25% since then. So that's always a threat that's kind of still looming. OPEC has kind of stepped in with the OPEC put. I think that's very important. This was also pre-regional banking crisis. I think you're going to see a lot more deflation, disinflation kick in because banks are going to have been freezing up their credit. The last thing I think is kind of the wild card moving forward, and I haven't really figured out how to deem this yet. We have a new head at the central bank in the Bank of Japan, and even though they have said that they are not going to pivot on their policy in any way, it'll be very interesting to see how this new governor handles the Japanese economy, because they have been the largest provider of liquidity than anybody over the last decade. So we have to, that meeting, I believe, is on April 28th. And I think that's going to be an interesting event because, the Fed has been tightening, but the Bank of Japan, the Central Bank of China have been loosening at the beginning of the year. That kind of helped fuel that rally in January. I think it's a weird thing to be, having a conversation about Japanese monetary policy, but Warren Buffett's over in Japan right now buying bank stocks over there. And I don't think I think that has probably more to do with policy than it does anything else. So as far as the Fed goes, the narrative is about to shift, and this is going to be a very important narrative for the next probably 8 months. We are going from how high to how soon in terms of cuts. I don't think the Fed is going to cut this summer. I think that they're not going to cut until the September meeting.
Until the September meeting. No, that's kind of what I think and I get the screen sharing up here. So just so everybody can kind of get what we're talking about. So the way these, when we talk about what the Fed is or what the markets expect, right? Here's this is on the CME's website. So they what they have here is the probability. So 475 to 500. This here is this is priced in the options, right? The options on the Fed futures for everybody out there. and they're pricing in a 29.6% chance of staying the same. And then yesterday, this was like 68. It creeped up above 70. And this is a 25 basis point hike, right? And so that 500 to 25 basis point hike is what they're pricing in for this next meeting. And then you can just click on out and go to June. And you can see that is a 70% odds of a pause. And then in July, it's actually a little bit, right? So this is not to say that they're convinced, right? But right now, the odds are skewed that there's going to be a slight rate cut. And then if you get to the end of the year, and you guys can, everybody here, you can get in there, cmegroup.com, and you can find their Fed Watch tool. It's real easy. But, we're back down another 75 basis points by the end of the year, which, that's that kind of back and forth, I think, is really detrimental to markets. But, I hear you on your yield curve. The Bank of Japan, when they had this new governor, the big expectation was all around that the new governor would pivot basically and abandon that yield curve control, right? The guarantee that they're going to they won't let bond yields creep above, I think it's now 50 basis points. Is that right, Garrett?
Yeah, I believe so.
Yeah, so 10-year yields at 50 basis points where they've been below for forever. Them and China and a few other central banks have actively started to cut. I think there's 3 or 4 other banks that are starting to cut. So, we'll see if we join that bandwagon. Jack, what are your thoughts around the Fed meeting and really, I want to hear, how are you positioning for that, man? You're a lot more active guy. How are you positioning for those moves?
I'm not going to try to predict anything with this guy. Powell has gone so far off the reservation that I don't think you could even come up with a scenario. You got some nice bets on there and stuff like this, but just listen to this. The purpose of the Fed is to provide a safer and more stable monetary system in pursuit of full employment and stable prices. I'd say the best thing that could come out of this next Fed meeting would be he telling people he resigned. He's done the opposite of what the whole purpose of the Fed is. He's put us in some crazy situations.
Yeah.
And I'd be afraid, I think he'd be afraid to cut interest rates this year just because he doesn't want to have to get back to wrestling around with this inflation thing. And he looks so far backwards, he's using such rear view mirror data that I've lost faith in him. So I don't predict these guys. I just set up what is a possible outcome and how would I react to that? Because the first time he cuts, there's going to be an overreaction. Stocks are going to rip. And I'm just looking for overreactions. I'm just going to not predict, but plan on reacting.
Yeah, I wonder. So I definitely think the medium, the less than immediate reaction to a Fed rate cut will be, a stock's going much higher. But I think, I wonder, and here's, not that I know one way have concluded one way or the other for sure, but I think there's the real possibility, especially since we're starting to turn into this recession. If the Fed cuts, it's an acknowledgement that things are bad, right? And that that the economy is their main concern, and so there could be a reaction, a pretty significant reaction to the downside on that. But yeah, I don't know. I'm not exactly sure what to think about that. But no, that's great. I appreciate your comments on that, Jack. And now
that's what I think.
What's that?
It's a little outside the box, but that's what I think. I think the guy's ruined the whole situation and he should just resign.
Well, yeah, that gets into the purpose of the Fed anyway, right? I remember, so I interviewed at Bridgewater years ago, maybe 10 years ago, a little bit more now. They asked me, so if you were president of the Fed, what would you do, right? And my answer was, I'd abdicate the throne. They didn't like that. But anyway,
it's fascinating to watch, largely because it's almost like there's only 10 central bankers in the world, and like anyone actually understands this stuff. And they've got 200 PhDs working at the Federal Reserve, and this is what they've produced. Yeah. So it's wild to watch this. Christine Lagarde still in charge in Europe. She was around the previous 2 crises. So it's wild. It's going to be the same names, and the idea of Powell retiring or stepping down, to be honest with you, Jack, that scares me because I don't know who the heck's coming next.
Right.
let me ask you this, Garrett. A lot of people say all these people that have been in the whole thing, they're academics, they're students. They don't have any leadership or wisdom, right? So, someone
Or
that
real world experience.
exactly. We got a guy in there that's a student of the game. I mean, come on, man. That scares me. I think we should get somebody in there that has proven leadership, proven wisdom, and can execute. I don't know, Larry Summers, whoever you think of him or whatever, but man, these students, 200 PhDs and a student running the show, that scares me to death, man. He ain't cutting his own grass. I can tell you that. They're all in.
Well, and then you start, if it's based on the current administration, right? If he stepped out, then you get somebody like Saul Omarosa or something like that. That's get rid of all banks anyway, and just bring it all into the state control. So that's kind of scary. And I pulled up this chart. I wrote about this a couple weeks ago. So since around 2011 or 13, the banks have been doing, or the Fed has been running these stress tests on banks, right? And I'm pretty cynical and skeptical, so I never had any expectation that they were actually stressing anything. But a couple of weeks ago, out of the PIIE, right? It's an economic forecasting organization. They went through all those stress tests and then ran a sample of what factors. There's something like 19 factors that they stressed, but there's 5 of them that are primary, right? The bank they run 5 different factors that have a major impact on the outcome. And so you got GDP, unemployment, interest rate, equities, housing prices, right? All of these things they moved around to see how the banks could withstand them. All those little lines in the middle, they didn't. They revealed that they didn't actually stress anything, right? They didn't stress GDP, they didn't stress unemployment, they didn't stress housing. The only thing in one scenario towards the end, they stressed interest rates, but the only thing that they did was it was a very short-term increase and then an immediate return to low interest rates because they knew they had control over it, right? So there's no wonder these banks are having a hard time right now because they weren't actually put through the ringer, So it's kind of like an inside game, right? The Fed and the banks, there's an inside game there to keep everybody happy, and it's a confidence game, and that's what they ultimately have to play. Well, Jack, with that, regional bank earnings are coming on, right? So the banks have, they have been squeezed with their long-term, with the declines in their asset values. The long-term real yields of long-term yields have gone up. Their asset values have gone down. They're in negative equity position. They're having to make emergency borrowings from the Fed discount window. What do you see with bank earnings, especially regional banks and that sort of thing? I know that's something both you and Garrett wanted to talk about. So what are you looking for?
Not good. They're afraid to lend, and they ain't going to make any money unless they lend. Car loans, they're afraid to make a car loan, a boat loan. Just any ridiculous loan, they need to loan. They need to lend money. They're not going to. How is buying bonds that have gone down in value? How's that help them? The only way they're going to make any money is do what a bank does. You can't make money on fees. That's old fashioned. They gotta lend the money. That's their spread. That's banking. And
their deposits are leaving, right? So they can't actually. They don't have anything left to.
They're going to coax them back with a 5% CD so they can make a 15% car loan.
Yeah.
So they got to put that money out there and just stop acting like, I don't know, like they're.
Yeah. So you think do you think it's going to be more of a bloodbath? Has a lot of it been priced in? What do you think?
I think they're hiding it. I mean, all these, it isn't just a couple banks that are in that position. Every bank's that's been doing the same thing. They're all in the same boat. It's just like they're all saying, don't tell anybody. But I don't see good things for regional banks. They got to get innovative. They got to do something different,
Yeah. Well, this is the same game that's been in place for a few hundred years now, right? Times are changing. Garrett, what do you think? I bet you find something out there that you'd like to hold, at least for the long term.
I mean, look, regional banking is a place that a lot of people don't really spend a lot of their time and focus. And it's very odd that the number one thing I'm watching Friday isn't JP Morgan, it's PNC Financial, to get a good sense of this. the regional banking crisis isn't as widespread as I think a lot of people think it is. You have to really look at the stability and the type of banks that were most impacted. And it was West Coast banks and East Coast banks. And we effectively got all swept up in an environment where everybody became a regional banking expert overnight, right? Like they were all climate experts a while ago, then they were epidemiology experts. Everybody gets on Twitter, and we effectively caused bank runs on relatively stable banks. There are a lot of stable banks out there. There are companies like TFSL is a ticker. It's a regional bank out in Cincinnati. You've got a lot of good banks that have insured deposits that have taken hits. And what this creates, and you have to recognize, we can sit here and we can analyze, the situation. This is creating an opportunity, everybody, because M&A within the banking sector has been one of the top trends since the 1980s through multiple crises. We've gone from 15,000 banks to 4,200 banks. It hasn't been bank failures driving that. It's consolidation. So right now, as you see people leaving places like New Jersey and Boston for greener pastures in Florida and Texas, these community banks are sitting here, not just the fact that they have these issues involving the bonds. And by the way, it's always something conservative that creates a crisis. It's treasury bonds and housing. It's not, widespread crypto causing a collapse in the financial markets, right? It's the most conservative stuff, and all of these problems go back to the Federal Reserve. The Fed creates the bulk of these problems. But if you look within this, there are lots of banks right now that have been beaten up. They're trading for less than the sum of their parts, the tangible book value of one. They're not exposed to cryptocurrency. They have good real estate loans. They have insured deposits. And that's where the M&A is going to be this year. It'll be in the companies in the regional banking and community banking space that have insured deposits that will be attractive in places where people are either leaving or where population growth is accelerating. So look for M&A activity in places on the East Coast, New Jersey, New York, Boston, and look for consolidation in places like Texas and Florida as these companies build scale. And I look at also, there's some regionals that, we'll talk a little bit about this. These are banks that it doesn't make sense to see some of the moves that we've seen, because they're good, relatively larger banks. And if they were to merge, they would create a super bank, right? Like a Truist or an M&T bank. I mean, you're getting real close now, where the too big to fail banks are going to see probably some forced consolidation at the mid-tier, and that's going to create some much larger banks that are going to compete against the Bank of Americas and Citigroups of the world.
Well, and that's an interesting point there, and it's a lot easier now, right? Operationally, so merging operations for a bank 10, 20 years ago used to be an absolute nightmare, right? A lot of paper processes, very different markets and that sort of thing. But the operationally in their back offices now, they're all kind of doing the same thing, right? I mean, everything has been digitized, and heck, half of them probably have the exact same, back office systems and that sort of thing. So for 5 regionals to get together, and come together as one is a much easier and a very lucrative investment banking deal, right? I mean, oh my God, I can see a lot of opportunity there, because now that's a really great point. So I think, there's definitely, so I'm with you. I think there's definitely some opportunities out there like that. What concerns me most is, kind of like, just because I can't get off macro, it's the big picture systemic stuff. In 2007, and I think it was in March of 2007, New Century Mortgage was the first company to blow up, right? I think they were the ones that were the owner. So the owner was like buying Lamborghinis and doing some movie with his girlfriend, and they were just blowing up left and right. It was going to do some action movie, right? That was what they were doing with customers. That was the kind of the money you could make off of mortgages back then, just by lending to anybody. Well, they were the first one to blow up. It was almost a year. It was pretty much a year later, then Bear Stearns blew up, right? And then 6 months later, it was Lehman, and off we were to the races. The bank troubles now, like, it's kind of tempered down, right? It's not as acute as it was on people's minds. Oh my God, they've already showed they're going to backstop the reserves, or the deposits, it will be fine. And so people have kind of moved on, but that's kind of the way they reacted. I spoke in a conference in October of 2007. I said, we got a big problem. there's all these CMOs and CLOs that this is going to be a real issue for the U.S. economy, global economy, and markets. And my boss said, do you have to be so negative? It's a problem because I was at a bank. I was working at a bank. In any case, some of that time, some of those things take a long time to creep, right? So the bank, the systematic or the systemic, the industry-wide problems on the banking side, there could be some real problems under the surface. But as far as individual banks, I'm sure there's a lot of really great deals out there. So that's great, man. I appreciate that. And Garrett, well, I got you, shale M&A.
Mm-hmm.
Okay, so I imagine the idea here is, a lot of, drillers and exploration production companies just been making money hand over fist, right? It's a heck of a lot better at 60, 70, 80 bucks, right? Than it was down at 30, 40 bucks where it was for for many years. And now, there's a lot of incentive to kind of boost U.S. production. All the global supply chains are coming in, right? Saudis are pricing their oil in anything. Everybody's dealing with Russia. Japan. Nobody's buying the sanction thing, right? And so, but everybody's going back in their own little corner. And that's and as a result, there's a renewed interest in making sure that there's a lot more energy production out of the U.S., or at least out of everybody except for the administration, right? That's a lot of money that they've made that they can put back into the oil patch. What are you seeing out there for opportunities?
There's a couple of moving parts here. One is on the energy on the energy side, you have to separate oil and natural gas. On the oil side, OPEC stepping in and doing its OPEC put, cutting production. That is in response to the Biden administration not buying up and setting the floor with the Strategic Petroleum Reserve. This is I've had these conversations with people in DC for the last month. We really had an opportunity to step in and buy at 65, and we didn't do it, and that was a policy error. But at the same time, if you look at some of the names in this space, you look at the Exxons of the world and the Chevrons of the world, the question is, where is their growth going to come from? And there's a lot of uncertainty there. There's a lot of uncertainty, particularly out of Europe. And there remains this kind of battle of does a company like OPEC and Chevron, do they want to be at the mercy of OPEC moving forward, in terms of global policy? And what you're seeing now is this idea that, look, we're going to probably be in a range-bound situation. These companies did not want to expose themselves to kind of the shale wars like we saw back in 2014, where everybody expanded production, and then all of a sudden oil went from $100 down to 40. And then we are in this environment now where shareholders are demanding returns. That's one of the reasons why dividends are so robust, why a company like Diamondback returned $800 million to their shareholders in December, Q4, including $320 billion in buybacks. These are attractive assets. A company like Diamondback, for example, its dividend is covered at $40 a barrel. For us to get back to $40 a barrel, I don't know what sort of economic downturn that looks like. So this deal,
and we got there in the first place. That was OPEC and Saudi-led OPEC saying, okay, we're going to squeeze these shale players out and just reduce the price of oil. Right. That's what they ramped up production to squeeze them out anyway.
So real quick, just the last point on this deal with Exxon, looking at Pioneer, that raises the asset prices of all of these producers. So it's not just oil; it's also the cash flow multiples that would be assigned to a lot of these oil wells and these assets. So I would look at companies, not just Pioneer, but be looking at Devon, be looking at Marathon, be looking at companies like Diamondback. If Pioneer didn't sell, Diamondback's the natural company to be taken over. On the natural gas side, natural gas is at $2. We have a situation brewing in Europe where they're going to not have supply again come June, July, August, September. They're going to have to refill. And you have
what's that situation?
I think natural gas is going to be moving higher. Natural gas, we turned on the spigots, and then ultimately we kind of had an oversupply because they did a very good job at conservation and also filling up their storage for the summer. The key thing to keep in mind here, we have a lot of companies moving to the United States to take advantage of cheaper natural gas. The pipeline companies that are moving natural gas, the companies like Energy Transfer, Enterprise Product Partners, EPD is the ticker. they're going to clean up because they're getting paid no matter what the price is. They're charging a toll. So I think natural gas is going to get back up to 3 probably by the end of the year. It's a 2.1. You just sit, you buy it, you hold it, and you just wait. It's going to take some time.
Yeah, no, and I guess you could put LNG companies in the same boat, right? And part of that was there was an LNG terminal that was shut down for several months. Now that's reopened now, so we can get more of that. Yeah, we can get more of that natural gas liquefied and out and exported. All right, hey Jack, now is that something that you think much about on the U.S.? Do you see anything there? You got any thoughts around that?
I do. I own first up, I got to say, I own a lot of Devon Energy, and I own quite a bit of Exxon Mobil. And I think Exxon Mobil is going to make an acquisition. And what I like about Exxon is, they keep talking about how the low carbon revenue is going to be bigger than oil down the road. And they're just going to have so much cash, at that point. Even if they buy another shale producer, I think they're just going to be really well positioned. But with both Devon and Exxon, like right now is a great time to sell covered calls.
Mm-hmm.
I own Exxon. Yesterday I was just out selling more covered calls. I've already got some covered calls on Devon because I don't know if this is going to stay up, but when these stocks rally, I love to sell covered calls, all the time. So that's how I'm looking at it.
Yeah, no, and I wonder how I definitely don't see anything that would oil back down to 40 would be, a really outside scenario. I can see the $60 to $80 range continuing for a while. I was reading something the other day that, with OPEC trying to cut and force it up that more to that $80, $90 range, there's a fair amount of defectors out there that aren't OPEC, right? Mm-hmm. Norway's upping their production. Russia's upping their production too, right? They're just exporting everything they can. But a lot of these non-OPEC countries are upping their production. So there's a balance there, right? I mean, it's not until we get into a real, ultimately all resources, I think, for the most part, are going to be bid much, much higher over the next 3 to 5 years, right? I mean, because there's just been massive underinvestment in CapEx in their development and that sort of thing. But this kind of nice Goldilocks zone that right in here that we've got $80 oil. It's not too painful at the pump, right? It's not squeezing the consumer too much, and at the same time, presents a tremendous opportunity for these exploration companies and production companies. So that's cool. Before we get, I know, Garrett, I know you got something you want to share with us today, but you had a couple things you wanted to say on commercial real estate before we go into that. Yeah,
I know there's a lot of focus right now on commercial real estate. There's a lot of people talking about crisis, the idea, of one point, all of this, these loans that need to be refinanced. I think it's important that people have to understand that real estate is a massive industry, right? It's the backbone of our economy. So let's not get lost thinking that, everything within the real estate industry is going to absolutely get popped. Doing analysis on from Green Street, which is one of the top real estate, research shops in the world. They effectively said, look, yes, the problem is in the office space. The problem is in the city by city retail space. And that's evident, not just within the trends of the real estate itself. Walmart announcing that it's leaving Chicago today. Last week, Whole Foods leaving. These are anchor names in certain areas of real estate. The places where things still look healthy are industrial and the digital REITs. Some of these digital REITs have been beaten up. DLR's off something like 40-50%. And you're expecting that the data centers are going to go down in demand over the long term. These are buy and hold types of things. So I think people have to, don't just scream out of real estate right now. Multifamily looks relatively stable and healthy. That's what a lot of the private equity firms are buying up right now. They're going shopping. I am steering clear, obviously, of the office space, and I'm steering very clear of the retail space right now.
Yeah, top tier office space and top tier markets. That's really what's getting all the attention, right? Because of the work from home. But other than that, it's still there. All right, man. Well, let's hear what you got. What you got for us?
Yeah. All right. Well, let me pull this up real quick. Make sure that I am I'm very tech savvy, as you can tell, right? Here we go. All right, so I'm going to share this, and then I'm going to hit this button and make sure that you can see me because I can't see you. All right, here we go. Is that good?
Yeah, you're good.
All right,
Golden, man.
everybody. So before I log off, I want to share with you a wealth secret, and it's, has the power to beat markets in all cycles. And this, we've talked today about finding value in this market, finding opportunity in this market. We talked about banks. We talked about energy. These are the places where opportunity is abound right now. And that's what makes what we're going to be discussing right now so important. So 186 years ago, a Commodore stumbled across a secret that led him to become the richest person on Earth. And it still works today on a handful of stocks. Like in the early 2000s, Freeport-McMoran, mining name, real stuff. This stock up 273%, while the S&P effectively flat during this roughly 14-month period. 130% on Photronics during the Great Recession that we had back in 2008. Big moves just simply using this secret. And in 2021, Intrepid Potash, a great company in the fertilizer space, a 240% gain using just a very simple metric. I call it the Commodore wealth secret. It's the only thing that has shown the power to beat the market returns in all cycles. And the Commodore was the name given to Cornelius Vanderbilt. You probably know the name. This is the man who built Grand Central Station with his own money, and he is was the founder of Vanderbilt University. It all started during the Panic of 1837. This was one of the worst financial crises our country has ever faced. I've spent my entire life studying financial crises. This and 1907 were very serious events, and they helped shape the economy for what it is today. And the secret out of this still works today in all types of financial crisis and in bull markets as well. Vanderbilt had found that the parts of the railroad, the ties, the rails, the locomotives and such, were trading for less than what they were worth. They were worth more than what the stock was trading for. So in other words, Vanderbilt could buy railroad stock that was trading for less than the sum of its parts. If the company folded and all the equipment was sold, he would make money. If the company went bankrupt, he would make money. If the stock recovered, he would make money. Just like what Vanderbilt did to build his multi-billion-dollar fortune, my system is built to isolate stocks that are trading for less than the sum of their parts. And that means even if a company goes belly up and all of its parts are sold off, we can potentially still see a positive return on our investment. So if we go back to March 2002, we would have identified DaVita. You may know this name in the healthcare space. This is a big Warren Buffett holding. And look at what happened from March 2002 through 2005. This was a 155% gain, 20x the return of the S&P 500. Or in November 2020, we would have identified Occidental, a name that we have been talking about. This is a Warren Buffett name. He's been buying the stock down around 57.50. Well, in the next 4 months, when this specific metric was in place, we had a 212% gain between November 20 and March 2021. But before you go off thinking it's time to buy the dip and load up on all the popular stocks that everyone else is buying, beware. Even after the steep declines we saw in 2022, stocks are still drastically overpriced. The overall price to earnings ratio of the S&P 500 is still historically elevated. And if you look at the Shiller PE, a measure of how overpriced or underpriced stocks are, we are up well above the mean historically. We are in what we call the danger zone, where stocks are priced way too high. You can see it has been trading like that going all the way back to mid-2021, a year after the Federal Reserve dumped capital all over the market, and that allowed all of these earnings metrics to just completely go haywire. Things are still overpriced. So the only way to build wealth in this massively overpriced market is to find the right stocks that are trading for less than the sum of their parts. And that's exactly what my system is designed to do. Like Friedman Industries in Texas, back in July 2022, Friedman is a company that makes tubing and steel products for the energy sector. And in less than 2 months' time, this stock moved from up 58.7%. in July 2022 to August 2022. This stock moved dramatically, 6 times the S&P 500 return over roughly 40 days. And today, I want to hand you 6 stocks trading for less than the sum of their parts in great industries, in a lot of the industries that we talk about today. So we will do so through the 6 foundational stocks for the tactical wealth investor. I'm going to give you the name, the ticker, the overview of the company, my professional analysis, and market research on each company. This is my targeted research of the 6 stocks I believe have the best chance of beating market-beating returns. And for your convenience, all of the information for these 6 stocks is delivered in one easy-to-read online report. You can get it free today as part of Tactical Wealth Investor. And this is my research service. This is the only place where I reveal stocks trading for less than the sum of their parts. Tactical Wealth Investor is a monthly investing newsletter where I share the stocks I believe are going to be best positioned for exponential growth. Right now, we have a rare opportunity to buy high-quality stocks that I believe will increase in value over months and perhaps years to come. And as soon as you join Tactical Wealth Investor, you'll get instant access to the Tactical Wealth Investor newsletter. This is delivered online the first week of every month. We do market commentary from me, and it includes a new stock that is trading for, you guessed it, less than the sum of its parts. I'll drop you a line via email, SMS, and Telegram when it is ready. We have 2 different portfolios within this service. The first is the Extreme Value portfolio. And here, I'm specifically focusing on individual metrics to find companies trading for less than the sum of their parts. These are solid investments that you can plan to hold for months, even years to come with confidence. Secondly, we have a high yield income portfolio. And here we're focusing on companies with dividend yields above 10%. They have very strong balance sheets, strong management metrics, and also a lot of these stocks are trading for, you guessed, less than the sum of their parts. These are unique opportunities that most institutional and retail investors overlook. They are typically in niche areas of the market, and we do a deep dive into each individual name as well. I also, to make sure that our communication remains regular, each month you're going to get a second portfolio update on the state of the market. This update is on both of our portfolios and updates each of our picks that include the current status, buy, sell, hold. Remember, in the middle of the month, that is typically a period where volatility can tick up. You have the 3rd Friday expiration happening. We look to try to provide you with as much information ahead of time so that you understand that yes, there might be some chop in the markets, but these are good long-term foundational stocks for you to buy and hold. And again, you'll get notified via email, SMS, and Telegram as soon as it's live. Tactical Wealth Investor Portfolio Tracker. For each model portfolio, you will be able to see where we stand on our positions. You'll also receive the Tactical Wealth Investors User's Guide. You'll learn my thought process behind launching this research service at this moment in time, the strategy behind it, the model portfolios, and what you can expect as a member. You'll also learn how to trade negative momentum. So if you know my focus, my 3 primary areas and anomalies are in value investing, insider buying and selling, and momentum. And momentum is an important metric that allows us to tell when capital is coming in and out of the market and how to position yourself as a long-term investor, even when there is volatility increasing in the market, how to pick the right opportunity, the right time to get in on some of these value stocks at a very steep discount. So in this detailed report, I will give you an expanded view of my momentum views, and also will provide some strategies that you can use to help trade successfully during any downturn. And typically when momentum goes negative, we see an average of a 4 to 5% downturn on the S&P 500 within about a week and a half. So it's an opportunity to pick up great stocks and go long, increase your dividend, increase your income over time. And all of this comes packaged inside the 24/7 online secure members only portal. Here you can track our portfolio picks and our tracker and catch up on any alerts or newsletters that you might have missed. My Trading Pub email is also included on this. I do this every day. You'll hear from me on the current market news, state of momentum, education, and give you updates. In addition, yesterday we talked a little bit about a name that we were discussing earlier, which was Diamondback. And these are major trends. Obviously, the M&A in the oil space, I'm talking about these trends and obviously a lot of things that you might not have heard about in the media. Last thing I'm doing, I'm going to back it all up with a very simple guarantee. All the risk is on me. A 365-day money-back guarantee. You're going to get 12 months to try out Tactical Wealth Investor. You could read the reports, see how the stocks do, go through every issue of the newsletter, and check out the mid-month portfolio updates. No matter how much you make in profits, my promise to you is this: you will have a 365-day money-back guarantee. You don't see value in this? If you're unhappy for any reason, call us up anytime within that year and get every dime of your membership cost back. You can even keep the reports, what we're giving away as part of this today as well. And that was just my way of saying thank you for taking the time to learn about investing, to learn how to improve your probability of success, just at checking out Tactical Wealth Investor. Now, you might be wondering, what's all this going to cost? Obviously, I think my time's worth quite a bit. 1997 was a number that we had kicked around for a while, but no, that's a little too high. I'm not even going to ask you to pay $997. We talked to our team and we agreed that our retail price would be $399 per year. But because the opportunities that are in front of us, because there's still a lot of uncertainty in ahead, and because I want a lot of more people to really learn how to become better investors, I'm going to make it even easier for you to join today. So I'm going to make Tactical Wealth Investor available at a substantial discount off the retail price. So do me a favor, go to wealthpress.com/roundtable or call 877-212-7581. You can join us and get in on the stocks that are trading for less than the sum of their parts. We have companies that are in the community banking space that we've talked about. We have a lot of names in the energy patch that look like great long-term investment opportunities, and we focus on some niche areas of the market right now that are deeply valued, including some names that have 8%, 9%, 10% dividends with upside potential, in my view, potentially in the range of 30 to 40% over the next 18 to 24 months. This is a very difficult market for people to navigate. It is very, very tricky right now. There has been a lot of chop in this market over the last 18 months. And my viewpoint is either you're going to be a day trader, which is very, very time consuming, or you're going to look out 18 to 24 months and buy great names, great companies now that a lot of investors are ignoring that have significant upside potential. As we know, we talk about Warren Buffett. He says price is what you pay and value is what you get. Well, here's the value. 6 foundational stocks report, the Tactical Wealth Investor newsletter, the mid-month portfolio updates, the extreme value portfolio, high income portfolio, the portfolio tracker, Tactical Wealth User's Guide, how to trade negative momentum. You have to check out that report. The members only portal, our email, the Trading Pub email, and the 365 money back guarantee, 365 day. If this is not for you at any point in the next year, you can call our team and get a full refund. Wealthpress.com/roundtable or call 877-212-7581. Don, thank you so much.
Yeah, Garrett, that's great. And hey, everybody, definitely you should check this out, right? I mean, this is how you build this is how you build wealth, right? You go in there, you buy stuff that looks good, not just cheap, but value, right? And wait for it to pile up. Now, you got a report or an update coming out soon. If they join now, they'll get an update that's coming out very soon.
We just put out our most recent report of our most recent pick, and this is in the regional banking space of all things, right? We just talked about this, and this is a name that is absolutely exploding in terms of its growth in Georgia and in Florida. Stock has pulled back precipitously, obviously because of the regional concerns. This is a very healthy bank with very strong assets, and it's the first time that I've ever seen the dividend in a long time trading over 5%. So the opportunity to buy and hold this name in the regional space and just simply dividend reinvest over the next 18 months. Once we get on the backside of this crisis, and I think we will within the next 18 to 24 month period, I think you're looking at a stock that's trading in the low 30s that can be in the 50s relatively quickly.
That's amazing. And what are those? And what, just real quick, we've got to hop here in just a couple minutes. But from what are the couple of main metrics you've mentioned a couple times on here? But what are the couple main metrics that you look at to identify these kind of value plays?
So there's a handful of places that you want to be looking, and you have to divide it between the financial market, the financials, and then obviously other places. So in the financials, one of the key things that we're always focusing on is tangible book value. So tangible book value is effectively the sum of the parts of the organization. You're taking all of the actual tangible assets, stripping out the debt, and then you're not including anything like goodwill or patents or trademarks. So think about it this way: if you have a good regional bank and there's $1 million in the vault, but the stock is trading for $800,000, right? You're effectively, the point that I'm making is that it would be at 0.8 tangible book value. Now you have to qualify all of these names. So for example, Silvergate right now is trading at like 0.1 tangible book value.
Right.
But they're likely going to go. They're likely going to implode. They're not going to be around much longer. So qualification is really important. On the other side, there's a lot of people who talk about price to earnings ratio and PEG ratio and some of these other things. That's wrong. That's not where you need to be looking. You need to be looking at things like enterprise value to EBIT. You need to be looking at some of these buyout multiples. You need to look at some things in terms of book value or price to free cash flow. But there's one last thing that's critical. Ben Graham had a number that can tell you it's a combination of its book value and its earnings per share growth. That number combined with another metric that we use, looking at like the F score and the Z score, brings us back to one number, and that's our tactical wealth number. And when we get the tactical wealth number under 0.5, we know that this company is trading at a defensive standpoint for well less than the sum of its parts.
Awesome. Thank you, Garrett. Well, I'd strongly encourage everybody, you got to join this service. I love Garrett's insight. Always love talking to hear what he has to say. And, you guys really jump on that. Jack, Garrett, thank you guys for joining. This has been a great session again. You guys are awesome.
Jack, where are you located?
I'm just outside of Naples, Florida.
Where in Bonita?
Yeah, Bonita. I'm right.
Okay, I probably live a mile from you.
Oh my God.
Amazing. Here you guys go.
So we got to get together.
I live right in the neighborhood for sure.
I'm up near Pelican Landing.
Okay, you're right. Yeah, you're just not very far from me at all.
All right, well, we'll get together.
Amazing.
Thank you so much for joining us today.
Yeah. Hey, so thanks everybody. See you guys next week. And Raleigh, excellent job. Way to keep things going. And we'll see you.
That sounds great. I'm going to grab the screen here just for a second, guys. Thank you for a fantastic presentation. Gang, some questions just popped up here about, what does the program cost, et cetera. When you go to that link, wealthpress.com/roundtable, here's where it takes you. So just think about it for a minute, what Garrett just covered. For 1 year, you can have his service for $49. For 2 years, you can have it for $79. And the VIP deal, which is lifetime, is for $299. So guys, once again, you get the foundational stocks, the tactical wealth investor. He's got 6 of these ready to go for you. You've got the, the extreme value model portfolio, the high yield model portfolio, the tactical wealth. I mean, on and on and on. Daily updates with what's going on in the market. And he's telling you, you're going to have 1 year, 365 days to go ahead and determine if you got value out of this program, and it's just going to cost you $49. This is what the special pricing is. 1 year for $49, 2 year for $79, lifetime for $299. What it all boils down to, at least in my opinion, when I think about the kind of edge that Garrett's providing you with, he shared it with you. He's going to help you determine, or he's going to find those stocks that are trading for less than the value of their parts. That's essentially what the focus is. And in this crazy environment, and if you believe what all the statisticians are saying, that stocks are overvalued at this point in time, how do you know what bargain stocks to invest in? Well, I think Garrett's got a real inside track on that, and that's what this program is all about. So I'm going to leave that up here on the screen. I'm going to go ahead and put the link in there one more time for you. But as he mentioned, he just released some updates today, and you can get those right away. So anyway, folks, we have to run. It's been a wonderful session. I certainly learned a lot. I hope you did, and we look forward to seeing you next Wednesday for our next roundtable event at 11 a.m. Eastern Standard Time. Take care, folks. Talk to you later.
Thank you, everybody. Thanks, Don. Thanks, Raleigh.
You bet, buddy. Have a great day.